Insight into auditing.
Deferred taxes. Hello. We're diving into one of the most intriguing concepts in financial reporting, deferred tax. You've seen companies report their accounting profit in their income statements. But then, when it comes to paying taxes, the taxable profit can be different. Investors consider accounting profit, while the government sees taxable profit, which can be different for the same financial period. Why the discrepancy? And what does deferred tax have to do with it? We'll demystify that and understand the concept in detail. The heart of the deferred tax puzzle lies in something called temporary differences. Simply put, accounting rules often differ from the tax laws set by the government, especially when it comes to when certain revenues or expenses are recognized. Think about depreciation. Accountants might use one method for financial reporting, while tax authorities may require another for tax purposes. These are temporary differences, they reverse over time. There are many other items that create temporary differences as well, such as revenue recognition, expense recognition, repair and maintenance, research and development, and so on. Temporary differences lead to two main outcomes: a deferred tax asset or a deferred tax liability. A deferred tax asset arises when you've paid more tax than your accounting profit suggests, or you're entitled to future tax deductions. It's like a future tax saving that you haven't realized yet. A deferred tax liability, on the other hand, means you've paid less tax than your accounting profit suggests, and you'll owe more tax in the future. It's a future tax bill waiting to happen. Let's look at a deferred tax asset example. Imagine a company setting aside a provision for employee pension. For accounting, they expense this now. But for tax, the deduction is only allowed later, when the actual payment made to employee. This means their current taxable profit is higher than their accounting profit. The company have paid more tax now than they should have according to their accounting books. This creates a deferred tax asset, a future tax deduction waiting to happen. Now for a deferred tax liability example, the classic depreciation difference. Companies might use straight-line depreciation over many years. But for tax, the government might allow accelerated depreciation, letting companies deduct more in earlier years. This means their current taxable profit is lower than their accounting profit. They've paid less tax now than their accounting books say. This creates a deferred tax liability, a future tax payment. So, why bother with deferred taxes? Because it ensures that a company's financial statements provide a true and fair view of its financial position and performance. By recognizing deferred tax assets and deferred tax liabilities, companies smooth out the tax impact of these temporary differences over time, matching the tax expense to the accounting profit it relates to, rather than just the cash tax paid. On the statement of financial position, also known as balance sheet, deferred tax assets are presented as non-current assets, and deferred tax liabilities as non-current liabilities. On the income statement, the total tax expense isn't just the tax you pay today. It's the sum of your current tax plus, or minus the change in your deferred tax position for the period. In a nutshell, we can say that deferred tax assets mean future tax saving. Deferred tax liabilities mean future tax obligation. Deferred taxes are expected to reverse over time. Deferred taxes help to provide more accurate long-term view of a company's financial health. Deferred taxes ensure financial statements reflect the real economic substance of a company's tax position.
Thank you for watching. For more videos, hit subscribe button below.